so when we talk about federal income taxes for individuals, everything ultimately ties back to one core formula. The individual income tax formula is going to provide a summary of how we calculate a taxpayer's taxable income, and ultimately whether they owe money or are getting a refund for the year. So all of these numbers flow directly onto the individual income tax return. That's Form 1040. So to make this easy to follow, we'll use a simple, relatable example throughout this module. So we're going to go ahead and meet Linda Larper. Linda works for a wine company called Planet of the Grapes. Yes, it's exactly what it sounds like, a vineyard. Okay, so she's a regular W-2 employee. She goes to work, earns a paycheck, and has taxes withheld, just like many taxpayers in the US. Alrighty, so for Linda, her tax journey starts with gross income, the total amount she earns before any adjustments or deductions. From there, we subtract certain allowed amounts called adjustments, which gives us what's referred to as adjusted gross income, or AGI. Okay, so AGI is a huge number in the tax world because it determines eligibility for many deductions and credits. So this is something that's going to continue to come up throughout this module and later on throughout this course. All right, so after AGI, Linda will choose either the standard deduction.
What's going on? My name is Joey and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score. So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all.
Or itemized deductions, whichever gives her the best tax benefit. And that gets us to her taxable income. So then we're going to apply the federal income tax rates. We're going to subtract credits that she qualifies for and factor in any other taxes to figure out whether Linda ends up with a balance due or a refund that will be deposited back into her bank account. So as we work through Linda's numbers, we're going to use this tax formula as our roadmap. Each line is going to have a specific purpose, and by the end of this module, you're going to feel confident navigating every step of the individual tax calculation. Okay, so now that we know the overall formula, let's break it down step by step using our example taxpayer, Linda Larper. So remember, Linda works at Planet of the Grapes, a vineyard where she helps cultivate some award-winning wine. So just like most employees, she earns wages, and wages are just the starting point of her taxable income. Okay, so step one is going to be gross income. Gross income represents everything Linda earns during the year that the IRS says is taxable. When the government looks at gross income, they aren't just looking at a paycheck, right? They want to know about all taxable sources of income. So for Linda, that might include her wages from Planet of the Grapes, any interest she earned on her savings account. Maybe she received a state tax refund last year or sold some stock for a capital gain. Even unemployment compensation, business income, rental property income, all of that gets added together to determine gross income. So the big idea is to remember if it's income and it's taxable, the IRS wants it included here. Okay, so once we add everything together, we're going to move into step two, adjustments. So adjustments are also known as above the line deductions. So these are special deductions that reduce gross income to arrive at that adjusted gross income or AGI number, right? That key number in personal taxation. So think of it like this. Linda starts with a big pile of gross income, but the tax law allows her to subtract certain items before calculating the rest of her tax. That's where these adjustments come in. So some common adjustments are going to include contributions to a traditional IRA, student loan interest that she paid, HSA contributions if she's covered by a high deductible health plan, educator expenses, let's say if in another life she worked in a school before switching careers, and a few other self-employment related deductions. So when these amounts are subtracted, what we get is AGI, adjusted gross income. And again, AGI is important because it affects how many other tax benefits Linda will be eligible for later. All right, so taking a quick pause here, we have now covered gross income, adjustments, and how we arrive at AGI. So next up, we're We're going to discuss how Linda's AGI helps determine whether she takes a standard deduction or itemized deductions to continue reducing her taxable income. All right, so step 3, we're talking about deductions. So now that we've calculated Linda's adjusted gross income, or AGI, it's time to give her another opportunity to reduce her taxable income. So that brings us to step 3, deductions. At this step, Linda must choose whether she wants to subtract the standard deduction or itemize her deductions from her AGI. And it's an either-or choice. She can't take both. All right, so the standard deduction is this flat amount set by the government each year. Almost every taxpayer qualifies for it, and it's designed to cover the typical expenses most people have, like basic housing and food costs, without needing to track receipts or proving anything. It's simple, it's clean, and what most taxpayers choose. All right, but Linda also has the option to itemize her deductions. So what that means is she would list out and deduct specific expenses she paid during the year. These can include things like medical expenses that exceed 7.5% of her AGI, state and local taxes limited to $10,000, mortgage interest if, let's say, she owns a home, charitable contributions she made, and casualty or theft losses in a federal disaster area. Okay, so itemizing helps when these eligible expenses add up to more than the standard deduction. So if Linda donated heavily to vineyard preservation causes or paid a lot of mortgage interest on her countryside home, itemizing could save her more tax dollars. Alrighty, so at the end of the day, Linda's goal here is going to take the deduction that is going to give her the larger reduction and therefore the lowest possible taxable income. Right, so once we subtract her chosen deductions, we'll have Linda's taxable income before QBI deductions, also known as qualified business income. All right, so from here, we're going to apply her federal income tax. And what we're going to drill into a little bit later is that her tax can either be the regular tax or the alternative minimum tax. And from here, we're going to reduce this for any credits that she might be qualifying for and other taxes such as self-employment tax if she owned a business. All right, so that's what we need to know about this formula for now. So as we continue walking through the individual tax formula with our friend Linda Larper, there are a couple of extra rules we need to keep in mind. Little footnotes that the IRS loves to sneak in. All right, so first remember how we talked about adjustments to income, like alimony paid and moving expenses. Well, those don't just apply to everyone. Alimony is only deductible if the divorce or separation agreement was signed on or before December 31st, 2018. Anything newer than that, no deduction allowed. And moving expenses, well, those are only deductible if you're an active duty member of the U.S. Armed Forces moving under military orders. So unfortunately, Linda can't deduct her moving expenses to be closer to Planet of the Grapes unless she unexpectedly enlists in the military. All right, so now we're going to shift to an important compliance rule. Who actually has to file a tax return? Most people assume that everyone has to file a tax return every year, but that's not necessarily true. Generally, an individual must file a tax return if their income is at least equal to the standard deduction for the year. So if Linda makes more than the threshold, spoiler alert, she must file. Okay, so there's also a special rule for older taxpayers. If someone is age 65 or older and gets an additional standard deduction, which increases the filing threshold a bit, then the IRS gives them a little extra relief, maybe to cover all of the retirement bingo prize income, right? And here's one more key rule. Even if someone earns very little, if they have $400 or more in self-employment income, then they are, again, required to file a tax return. So a kid running a successful lemonade stand or a weekend dog walker could technically owe self-employment tax. Meaning we're going to discuss how Linda's AGI helps determine whether she takes a standard deduction or itemized deductions to continue reducing her taxable income. All right, so step 3, we're talking about deductions. So now that we've calculated